supposed to make of the home builders? Despite some strong housing data we've gotten recently, the group's been a mixed bag in terms of performance. We have to worry about this Fed rate hike all the time. And we think that could put a dent by buying mortgages become more expensive. Obviously, maybe people won't buy as many homes. Still, when Toll Brothers, #1 luxury home builder in this country, reported a few weeks ago, they totally knocked it out of the park, setting their stock up nearly 9% in a single session. That was right. It went from 29 up to 31. What got people so excited? Well, Toll delivered a nice top-line beat with in-line earnings, but more important, headline numbers. They mattered, but it was the 18% increase in net signed contracts, 90% increase in their backlog. I thought that was amazing. And the fact that management gave bullish full-year guidance. Plus, the commentary in the conference call was entirely positive. Yet since then, Toll Brothers has pulled back to the point where its stock is now trading below where it was before it reported. Like the past quarter never happened. Some of that's anxiety about a possible rate hike, but given that the stock's already down 13% year to date, I got to wonder if it could be just a buy. Let's take a closer look with Doug Yearley. He's the CEO of Toll Brothers. Find out more about how his company's doing and where it is headed. Mr. Yearley, welcome to Mad Money. Good to see you. Thank you, Doug.
Nice to see you.
Doug, I have followed your company since it came public, and you know I know Bob Toll.
Yeah.
And I have.
You're a Philly guy.
Yes, I am. And he's a huge Eagle fan like me. You see him at the games before I switched my seats because he was right next to me. But the one thing that has shocked me is that the whole time you guys have never really been big buyers of stock. This year, it's an incredible amount of stock you're buying. Tell us why you switched directions and just think that the stock's too cheap and you got to buy.
So we bought back about 7% of our stock in the first 3 quarters of 16. It was the opportunity. Our book value is in the high 20s. Our stock was trading in the high 20s. Right. We have some of the best growth in the industry right now. Our order growth is leading the industry, or up there at the top. Our earnings are at the top. Our margins are at the top. There's been this fear about luxury that, frankly, we're not seeing in our business. There's been a great flight to our brand, and we just saw where the stock price was laying around, and this year was the time to buy a whole bunch back.
Okay, because we have a lot of home gamer, I call them retail investors. When you say book value, what you're saying is basically what this company is worth, its land, its prospects.
That's right. So, and if we have the leading margin in the industry, you would think our book is pretty secure.
Yes. Well, that's what's confusing me. Now, one of the things that I want to go over, you mentioned about the high end. What is the sensitivity both to the high end, because that's where you are, and then to the other end, where some of these stocks are doing much better than yours, but I can't figure it, to an increase, say, of half a point in mortgage rates? Who does it hurt more?
It hurts the lower end more because it comes down to affordability. It comes down to dollars and cents of what they can afford in a given month. Do they continue to rent, or is the rate such that they can afford to own? Our buyers don't max out their mortgages. Our average LTV is 70%. 20% of our buyers are all cash. This is their second, third, fourth home they're buying in their life. And while a major move in rate would hurt us, a small tick will have no impact. I've always said I will take a rate that's 4%, 4.25% in a strong economy over a 3.5% rate where we've been for a long time, in an economy that is not as good. So when the Fed talks about maybe there's a rate increase and the builders sell off, that to me is good news that there might be a small rate increase because the economy is strong, yet the market is reacting to us short term with a sell. And, that's what frustrates us.
Are you still buying stock?
We haven't bought any yet this quarter, but we will certainly continue to be in the market, and you will see us continue when the opportunity presents itself to buy stock back.
Is there news that doesn't allow you to buy it, or it's just
No. You know, we're always balancing land opportunities we have with the money we have, because that's our growth versus stock buyback, and we will continue to balance.
All right, let's talk around the country, because you're in a lot of great regions. California, how is it?
Fabulous.
Really? Just fabulous?
Fabulous. We're in coastal California, northern and southern. We're not inland.
Okay.
We did a huge deal 2 years ago when we bought Chappelle, $1.6 billion, which it transformed the company. We now have 25% of our business coming out of California. Orange County, LA County, Ventura County, South Bay and East Bay of San Francisco. Fabulous.
And average price of those places?
$1.2 million to $1.5 million on average.
Really? And that's just not a problem. You're selling them.
We're killing it.
Okay, how about in the middle of the country?
Midwest has been slow. Our best market is Detroit. Not a lot of job growth in the Midwest.
Okay.
We're also in Minneapolis. We're in Chicago. We like what's going on in Michigan. There's actually been more job growth as the auto companies have done better. But that's not a big growth territory for us.
Florida?
Florida's good. We need more land.
Okay.
Very hard to find land. We're doing very well in Jacksonville. We're doing very well in Orlando, which tend to be primary home markets. and then the second home market and the retirement areas of the Gold Coast, of the East and the West Coast, they're good. We just need more land.
Okay, then round circle from what had been not that great. Northeast, great.
Northeast is great. You know, we dominate Boston to Washington. That's our home turf. We're out of Philadelphia. Very few big national builders are there, so we tend to dominate the land buying. We have a great brand because we grew up there.
Right.
It's hard to find land.
Yeah.
It's hard to grow because it's so difficult to get land entitled. It may take 5 years in New Jersey to get a farm approved for houses. But when you get it, it's gold.
And I wanted to ask you, I've been looking at this Apple Home Kit. Is that something, is it Toll Brothers outfitted electronically to be able to do the kind of HomeKit things that we see?
Oh, we do a lot of it. We don't use Apple right now. We're looking into that, but we use another company right now called Control4.
Okay,
but we're all over it.
Okay, last question. The Fortune rankings were pretty amazing. How did that happen? Just tell people what you are and how that happened.
So Fortune magazine ranks the most admired companies by industry,
right?
And we've been winning in home building.
Right.
And then they rank worldwide of all industries for the quality of product. Right. And all of a sudden, little Toll Brothers out of Philadelphia is number 6 on this list worldwide. The only companies in the world ahead of us are Apple, Amazon, Nordstrom, Google, and Disney. That's it.
I thought that,
and then Toll.
I thought that was amazing. So you're the most optimistic I've heard you, and I hear you in all different venues that I can recall.
Well, you know, Jim, we announced 3 weeks ago, 3 weeks into our new quarter, that our deposits, which is an indicator of what's coming, because it's when somebody puts a check down on a lot, we're up 23% for those 3 weeks. We're now 3 weeks further in. We are up 25%.
Okay, that's great news.
That's
news.
We're rolling.
All right, that's great news, and that's really, I did not know that, and thank you so much for sharing it with our viewers. That's Doug Yearley, CEO of Toll Brothers. The last thing he said for terms of these stock jocks is going to be the most important thing you heard. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.